Welcome to the weekly wrap-up where we take a look at what economic events were moving and shaking the markets this week. Today I am joined on the line by Baumohl, Chief Global Economist at the Economic Outlook Group. Thanks for joining me, Bernard. In your view, what were the most important economic events that impacted the markets this week?
Well, there were probably three main drivers that affected the markets this past week. One was just additional news that central bankers around the world will continue to be accommodative. We certainly got more information from the Bank of Japan, its new leader, Haruhiko Kuroda, who does seem committed to pursuing much more accommodative monetary policies with Japan. And we also got some news even in the United States from the minutes from the Federal Open Markets Committee that didn't show any surprises, which was good. And there was the expectation that with some soft economic news in the U.S., like this morning's retail sales report, that the Federal Reserve also will not be in a rush to end its quantitative easing. So that's the first part, was that central banks appear still more committed to remain soft and accommodative. The second, I think, is the expectation that perhaps earnings analysts were a bit too bearish in the first quarter, and that we could see some upward surprises on earnings, and that too has helped lift the stock market. And finally, I think there was some surprising news on the growth in Chinese imports. Now, whether that report can be taken on its value, there has been some question about the validity of that report, but nevertheless, people did react positively to it because it does show that China's economy is strengthening, and that is good news for the global economy.
China's consumer price index came out on Tuesday, falling to 2.1%. What do you think this data means for the Chinese economy?
Well, certainly the inflation rate of China came in way below expectations. In fact, inflation in the first quarter is running at a pace that's even less than all of last year. And I think the primary conclusion one has to draw is that the risk that the Bank of China will tighten has diminished. There probably will be now less need to raise interest rates or to lift reserve requirements in China. And that, of course, is a positive thing because it now allows China to grow more steadily, and that's important. I think the main risk to the economy in China is not inflation, but balanced growth. Obviously, inflation, they're going to be watching inflation carefully there, particularly on the food front, which is so politically sensitive. But for the most part, it's not inflation. It's just going to be balanced growth and the really difficult challenge that China faces in having its economy transform from an export-oriented country to one that is more reliant on its consumers. That is a very difficult process that has to be watched, particularly under its new leadership. But the inflation issue, I think, the fact that it's running below expectations is certainly a positive development for China.
What did you make of the Federal Reserve minutes from the March 19 to 20 FOMC meeting released on Wednesday?
There were no major surprises in that release. We knew that the key topic of discussion will be about when and how to begin the exit strategy for the Federal Reserve. When will it start to scale back its quantitative easing? That has been the subject of debate within the Fed. It continued to be that in the latest minutes. They just proceeded to discuss it in more detail. Anything that we can glean from that report, it's that there have been some that have called for the Federal Reserve to scale back as early as June and to end quantitative easing by the end of this year. But I think that is far from a done deal, especially with some soft economic numbers coming out in the U.S. So whatever they do will be much more dependent upon what happens in the labor markets in the U.S. and inflation in the coming months. What the release did not mention, which I think is very important and will increasingly become a concern in the financial markets, is one of the biggest questions of all. Will Ben Bernanke, even remain as chairman of the Fed to oversee the exit strategy. We don't believe it is likely he'll stay on after January of next year. He will not be probably at the helm to oversee the exit strategy. So at some point in the next couple of months, there's going to be a lot more debate as to who's going to take his place and what philosophy that individual has. I wish there would be more discussion about that in the minutes, but there wasn't any.
On Thursday, we saw Australian unemployment for March increase to 5.6%. What does this increase mean for the Australian economy?
Well, Australia has a great economic story to tell. It has been free of recession for the last 30 years, but that 5.6% increase in unemployment, it's significant. It's a 3-year high for Australia, and it shows that the country is going through a rough patch right now. It's not surprising. The Australian dollar has been strong. It's been above parity with the U.S., and this has hurt Australian exports and tourism. Keep in mind, Australia has something of a two-speed economy. Western Australia is really doing quite well. It's very strong there because of its mining activity, while the south and east of Australia have been hurting. They're mostly manufacturers, builders, and retailers, and they've taken the brunt of the slowdown. My expectation is that Australia will bounce back because interest rates are still quite low there, and with China's economy picking up speed, they're going to be buying more goods from Australia, and I think that will eventually affect all the other sectors in Australia's economy. So we're still looking for growth, and we're looking for conditions in that country to improve with a lower unemployment by the end of this year.
German consumer price index year-on-year remained unchanged at 1.4% this week. Is this a good sign for the German economy?
Well, look, Germany, historically prefers low inflation, but not if it came about because the Eurozone is in recession and therefore dragging down prices in Germany too. Germany had a negative economic quarter at the end of last year, and they too want to see positive growth. And I think that there is now room for them to even allow inflation to move up. By the way, on a harmonized basis, Germany's CPI was actually higher; it was at 1.8%, which is often how we tend to look at it because we need to compare it to the other European countries. But look, I expect that the Eurozone will begin to pick up some more speed. That's going to improve that's going to, I think, help improve Germany's economy and allow inflation to inch a bit higher. I'm not particularly concerned about Germany right now. The domestic wages are still quite strong, and with the low inflation, that's going to increase purchasing power in Germany. So I think the rise in purchasing power plus the gradual improvement in the Eurozone economy later this year will help also improve Germany too, and it'll likely tick up inflation slightly, but nothing to be alarmed about.
That's all for now, but stay tuned to Dukascopy TV for the latest financial news and updates. Have a great weekend and goodbye for now.